Hello everyone, my name is Arias and welcome to my show. Today we will be taking a deep dive on Lemonade, an insurance company that I am very bullish about. We will talk about what differentiates Lemonade from other insurance companies and why I think this stock could 10x in the next 10 years. If you like Lemonade content or videos where I go super in depth and tell you everything I know about a company, leave a like and leave any feedback in the comments below. Stick around to the end and I'll go through my detailed projections for Lemonade and what my cost basis and position size is. With that said, let's get right into it. Real quick, let's get into some news that came out as I was making this video of a new capital raise by Lemonade announced Monday night. They will be selling 3 million shares with the option to sell 678,000 more shares depending on investor demand. There will be roughly 500 million in proceeds to Lemonade, and there will be roughly 6.5% dilution to existing shareholders. They also announced an additional 1.5 million shares that will be sold by insiders. The CEO, who we will talk much more about later, is selling 300,000 shares, or about 2% of his stake, but he will still own about 25% of the company, as will the COO, who isn't selling any shares. Now, I absolutely love this move to take advantage of a stock price that has exploded in the new year and use this to fortify their balance sheet so they have maximum flexibility going forward. Now let's get into the rest of the video. Let's start out with my core thesis with regards to Lemonade, and that is that they can offer a better service with better customer experience at a lower price to the consumer, and this will drive dramatic customer adoption. Additionally, due to their digital nature, they will have superior economics and superior growth that will drive significant long-term value for the company. This is the so-called flywheel that will drive value for Lemonade. Starting from the top, as they provide a great experience for customers, they grow fast. When they grow quickly and reach a large scale, they accumulate lots of data to feed their machine learning algorithms that improve and create a greater still customer experience that continues to propel the flywheel around again. Let's talk about what makes Lemonade special, in my opinion. The founders rethought the way insurance should be designed from the ground up and decided to implement a new structure whereby Lemonade keeps a maximum of 25% of the premium and will donate some of the remainder that is not paid out in claims to charities of the consumer's choice. This aligns incentives with consumers because consumers don't feel the company is less likely to pay their claim to prop up their bottom line, and this creates a better customer experience. We'll get much more into detail on this later as well. The second characteristic that differentiates Lemonade is their proficiency in AI. They collect more than 100 data points to train their AI during the sign-up process, much more than the 20 to 30 questions that are normally asked when signing up with a traditional broker. They use this data combined with their AI to offer the most accurately priced insurance to each customer. Put differently, they give lower prices to those who present lower risk and higher prices to those who present higher risk. Another thing Lemonade has going for it is the lack of legacy infrastructure that the 100-year-old insurance giants have and the digital nature that takes its place. The whole world is going digital all around us, and now at an accelerated pace. It is only a matter of time for the insurance industry to do the same. All of the bricks and mortar brokers with thousands of employees will become a liability in this age, and that is something Lemonade will not have to deal with given their digital beginning. Lemonade's digital nature allows them to expand very quickly into new geographies and to launch new products as well. This has led to their extremely fast growth of over 100% in recent quarters and will allow for this hyper growth to continue far into the future. Let's talk about their give back and flat fee structure that attempts to align incentives better with their customers. The insurance business is known for taking premiums in good times and then being stingy when it comes time to pay out. This can be seen in the Urban Dictionary definition shown in the top right corner, defined as a business that involves selling people promises to pay later that are never fulfilled. It goes without saying that this is a poor reputation to have, and this results from the fact that insurance companies benefit from not paying out claims to consumers. Consumers perceive that when a claim is denied, that insurance companies make money and are therefore distrustful of their insurance company. They will therefore have less moral qualms with defrauding their insurance company to get what they see as what they are owed. Lemonade tries to change this behavioral pattern by taking a 25% fee of the premium and then giving back the excess premiums to charities of the consumer's choice. The combination of these two practices increases the trust that the consumer has that Lemonade will most likely pay their claim and thus are less likely to inflate their claims to get what they feel they deserve. They are also less likely to defraud the company as they know their claims come not at the expense of Lemonade but at the expense of their favorite charity. These factors combine to reduce fraud, which aids Lemonade's loss ratio, but also allows Lemonade to pay more claims faster, which increases the quality of the customer experience. Customers may also feel proud about the charity that they are contributing to, which also aids their customer experience. All of these factors contribute to their Net Promoter Score of 70, which is comparable to loved brands like Amazon, Apple, and Netflix. It also led to some extremely unusual stories. For example, CEO Daniel Schreiber told of a customer who filed a claim after losing his laptop. Lemonade paid him, but a few weeks later they got a message saying he had found his computer and would like to return the claim to Lemonade. Schreiber said he reached out to other insurance executives, and this was unheard of. They had no process to deal with this. This story is an example of how Lemonade creates trust with their customers by aligning incentives, and this leads to a superior customer experience for those consumers. Another way Lemonade attempts to provide a superior product is through their high level of efficiency within their business. Their onboarding process is handled by their chatbot Maya. As a consumer myself, the sign-up process was easy and intuitive, much better than the outdated website that my prior insurance carrier presented. They also handled the beginning of their claims process with another chatbot, Jim. This enables the payout of about 1/3 of their claims in seconds, while the rest of their claims are escalated for humans to evaluate. Even when a claim is unable to be paid instantly, Jim collects all the relevant information to the case for the actuary. With all of the relevant information, the process becomes much more efficient and less employees are required to process claims for many customers. They are also able to process claims more accurately because they have all of the information needed. One story that Lemonade's CEO told relating to this was one time a potential customer submitted an inquiry asking if renter's insurance would cover his scuba gear being stolen from his car. It would, and later he signed up. And what do you know? 2 weeks later, it was stolen. Lemonade's software was able to present this to the actuary to make a prudent decision about this case. However, most claims aren't fraudulent, and because of Lemonade's technology, they are paid out as quickly as possible, which contributes to a better customer experience. Now moving on to the second part of my thesis, that Lemonade's digital nature will allow them to have superior economics and growth. The use of AI is integral for Lemonade to derive superior economics, and is used to optimize all functions of the business. As I said on the last slide, chatbots handle the onboarding and claims process. They also use AI for detecting fraud. When customers submit a claim, they upload a video of themselves saying what happened. Then AI analyzes the video and can find things that humans may not. For example, if the subject is wearing a wig. This reduces fraud. Another way they use AI is in combination with a government satellite that flies over the US twice a day. The AI will use these images to look for areas that have active natural disasters, like a hurricane or forest fire, and then stop ad spend on new policies in that geography, and make the claims process more available in these areas. The digital nature of Lemonade allows them to capture orders of magnitude more data about the consumer in any interaction than their broker-based competition. This allows them to price the coverage most accurately for each consumer. Overall, with the integration of AI into Lemonade, it reduces the cost to the consumer and improves the consumer experience. For shareholders, the use of AI reduces loss ratio and increases internal efficiency, which will make Lemonade more profitable in the end. Now let's talk a little about reinsurance. This is a part of the company that I think is confusing to many people, but is not actually all that relevant to the business in the long term and the value it will drive. Lemonade's current agreement with reinsurers, which took effect in Q3, cedes 75% of their premiums to reinsurers, who then pay 75% of each claim. Lemonade, of course, then picks up the final 25% of each claim. Going through the financial statements, I am a bit unsure of this part, but I believe that the reinsurers then pay Lemonade back 25% of the premiums they were ceded as a fee for the transaction. If this were true, Lemonade would pay 25% of the claims while keeping 43.75% of the premium. This arrangement, of course, is very beneficial to Lemonade in the short term, as they need less cash on the balance sheet to pay out claims and can instead focus on using that cash to grow as fast as possible. Another thing to note is when this took effect last quarter, it had a massive effect on the way revenue was recognized, so much so that the GAAP revenue appears to have shrank year over year, as you can see here on hypercharts. However, for the long term, I would contend that the specifics of this agreement are not all that relevant, as Schreiber has already indicated that reinsurance may not be the route that Lemonade takes long term. He says that they would continue to use reinsurance as long as it was beneficial to Lemonade. He also commented on how using reinsurance inevitably cuts into Lemonade's bottom line, as the reinsurer has to make some profit off the transaction as well. In my opinion, long term, Lemonade will not use these agreements and will take on the full risk of their business. As an investor, I choose not to get bogged down in the reinsurance, as it is a short-term boost to the company, and in the long term it will not be a factor. Now let's talk about Lemonade's growth strategy, the first half of which is expanding their different product offerings into different geographies. During the pandemic, they launched in France, which expanded their offering in Europe, which already included Germany and the Netherlands. While it may seem trivial to have offerings on 2 continents, this is actually extremely unusual in the insurance arena. However, due to Lemonade's digital nature, they are able to achieve this feat. With this ability, they may be able to expand in other big market opportunities like Asia, and certainly in the rest of Europe. They will also continue to expand to the states where Lemonade is offered as well, and Lemonade's digital nature enables this expansion of geographies, as they have no physical presence to set up. They only have to comply with the regulatory framework and then begin running ads in that locality. They can also quickly launch new products through their platform. They launched pet insurance in the first half of 2020 and plan to launch life insurance in the beginning of 2021. I expect Lemonade to continue rolling out further products until they offer insurance to meet all of their customers' needs, which is integral to the second half of their growth growth strategy. This is all, again, relatively easy due to the digital nature of their platform that Lemonade has built. The second half of the growth strategy that I alluded to on the previous slide is once they acquire customers, offer them all of the products they may need in their life. Lemonade acquires most customers early in their life cycle from non-consumption, meaning Lemonade is their first insurance company. As I said earlier, Lemonade will expand their product offering until they meet all of their customers' needs. They currently offer pet, renters, condo, and homeowners insurances. Their current customer path is to acquire customers as renters and then upgrade them to condo or homeowners policy as their life progresses. They will also offer them expanded options with pet and life insurance policies along the way. This progression will lead to long-term revenue growth for the company. As you can see in the top right, Lemonade will look to augment this progression by adding travel, auto, and umbrella insurance as well. Let's talk for a moment about their loss ratio, which is the percent of premium they have to pay out in claims. It has improved significantly over the last few quarters despite explosive growth, and this is one of Lemonade's core competencies, using AI and data collection to lower their loss ratio while continuing to grow at extremely high rates. Impressively, in Q3, with wildfires in California and record hurricane activity in the Gulf, they maintain an acceptable loss ratio despite all-time high cat losses. Management has stated that they will continue to grow as fast as possible while keeping their gross loss ratio around the 70 to 75% range. Let's talk now about their competitors, both legacy and new age. I'd like to start by saying that insurance is an absolutely gargantuan industry that supports multiple companies with less than 10% market share, still worth $30 to $50 billion or so there is room for multiple competitors. Starting with the legacy competition, they are all nearing 100 years old and are at some obvious disadvantages compared to Lemonade. First, they have legacy systems integrated in their business that will hamper their advances into the digital age, in my opinion. They have old brick-and-mortar brokers that reduce margins and will become a burden the further society moves into the digital age. Can you imagine in 15 or 20 years wanting to walk into a physical location to purchase an insurance policy? I can't, and while I do recognize that these companies have set up digital distribution channels and will likely survive long into the future, I believe Lemonade will take market share and become comparable to at least these giants today. Moving on to the new age competitors such as Root and Metromile. These businesses are interesting to me and I don't have many bad things to say about them. Metromile is merging with the SPAC INAQ and is endorsed by Chamath Palihapitiya, whom I have great respect for, as you would know if you watched my video on Clover Health. Root IPO'd in October. They both appear to be good businesses and worthy competitors to Lemonade. However, I have chosen Lemonade because they have a unique setup with a give back and are currently ahead in the amount of data collected and revenue. They also are focused around renters and home insurance rather than auto, which I think will eventually become a tough business to be in, as Tesla will be dominating this sector, and this plays a large part in my decision as well. In the end, I see no end-all competitors in this space. I see many competitors, however, being able to hold on to some market share, both legacy and new age competitors. However, look for Lemonade to take an outsized market share as they build an insurance company for this century. Now let's talk about the management, which is an extremely important part of every investment decision. You must believe in the CEO and their vision, in my opinion, for a company to be a game changer. In my view, Daniel Schreiber is that guy. He's the owner, operator, and founder that I want at the helm of the company. While he is new to the insurance game with Lemonade, he has been involved in tech startups for years. He and the co-founder look for an arena untouched by technology, and they found one in insurance and created a disruptor in this arena. His co-founder and COO, Shai Winiger, is also integral to the company. He's the product designer and he's very detail-oriented. He was also the co-founder of Fiverr, which is the current leader in freelance work sharing. At the time of the IPO, these two owned 57.3% combined of the outstanding shares. However, they have since sold some, and as I mentioned before, own about 25% of the company each. This shows strong confidence in the business going forward, as the experts I want running the business own a controlling majority of shares. For a moment now, let's consider the risk associated with Lemonade. The major risk that I see is that they fail to execute on launches of new insurances and fail to grow the customer base, and this causes their growth to slow significantly much sooner than anticipated. Today, their valuation implies insane growth, and if they fail to grow exceedingly fast, their stock price will stagnate. Another risk is that the legacy competitors find a way to leverage their total amount of data with AI to create more predictive data models and are able to beat Lemonade at their own game. I think this is extremely unlikely. While I don't think these dinosaurs will go extinct for another century or so, I don't think they will evolve into a new predator that will beat the current best of the best. Another risk is that competitors such as Root or Metromile execute so much better than Lemonade that they beat them out of the market entirely. I find this unlikely as well because Lemonade's execution is excellent, and I think there is space for multiple companies to grow in this area. Another risk, however small, is unforeseen huge cat losses. Think mega tsunami hits an entire coastline, or the Yosemite supervolcano spews heavy ash over the entire continent. Although although I would bet there would be some governmental support in this case. The final and perhaps biggest risk may come from if one of the big tech giants leverages their distribution to get into this space. There are only a few markets large enough to move the value of these companies long term, and insurance is one of them. Imagine Google, who has some of the most excellent AI acumen in the world, and using the fact that we use their search browser and search engine every day and have devices of theirs all around us to launch renters or home insurance products. Amazon is in a similar position, and Apple is in a slightly less advantageous position, but all will be significant threats to the long-term growth of Lemonade. Just in the news of these giants entering the market would cause a 30% plus sell-off in my opinion. While I am highly bullish on Lemonade, these are some of the risk factors to watch out for, most of which is a slowdown in growth. Now let's get into their financials. They had an in-force premium, or IFP, which is calculated by the average premium per customer times the amount of customers, was up by 99% year over year to $188.9 million in Q3. Their average premium grew 19% to $201 per customer, and their customer base grew to 941,000 customers, representing 67% growth. Their IFP growth is slowing slightly from 138% in Q1 to 116% in Q2, and most recently 99% in Q3. This is the indicator to watch for me. Wall Street, according to Yahoo Finance, only expects 20% growth over the next year. Now I think they could decimate these estimates, and if they don't, I will be much less interested in holding this stock long term. They have a solid balance sheet with almost $600 million in the bank, plus the roughly $500 million from the recent capital raise, with no debt. They are still unprofitable, of course, as they have lost between $20 and $36 million in the past 4 quarters, which still gives them plenty of runway to get profitable. However, there will be dilution in this stock in possible future capital raises, but definitely in employee compensation, as it is a high growth company, so be aware of that. Gross loss ratio, which is another important indicator, has decreased to 72% in the last quarter, down 7% year over year. Gross earned premium increased to $42.9 million, up 170% year over year, which is growing even faster than IFP. Their market cap is $9.992 billion as of closing trading on Wednesday. Their stock has doubled in the past month and is up nearly 60% year to date in just 11 days. Keep this huge run in mind when considering when to enter a position. Now let's get into the fun part, projections. These are all just food for thought and should not be considered in any way financial advice, so please do your own research. My most conservative projections show Lemonade halving their growth from roughly 100% this year to 50% next year, and then continuing to decline from there. I think these growth rates are preposterously low for such a quality business positioned so well, especially towards the tail end of the curve. The 2031 projections will leave us with $12.4 billion in revenue. A low price to sales ratio of 1.5 would leave us with an implied value of the business of $18.6 billion in 2031. All I have looked at are in the 12 to 10% range. There would be $993 million in profit in 2031. With a low PE ratio of 20, the implied value in 2031 would be $19.866 billion. This would be roughly a double from here in 10 years, or about a 7% CAGR, so you'd probably be better off in the S&P. However, I think these growth projections are much too low, and we are truly just in the early innings of a long runway of growth for Lemonade. So let's look at some more realistic projections. Now let's move on to my base projections for the company that I think show its potential. These projections have Lemonade growing at IFP at 80% next year and steadily declining to 20% growth in 2031. These projections would give Lemonade $21.8 billion in revenue in 2031, a fairly low price to sales ratio for a hyper-growth company like this of 2. This would imply a value of $43.6 billion in 2030. With a profit margin of 10%, which is still lower than that of Allstate or Progressive, they would generate $2.2 billion in profit. If you assign a fair PE ratio of 30 for a company like this, that would imply a value of $65.5 billion in 2031. This growth is pretty substantial, especially considering I got into this stock at around a $3.5 billion cost basis. However, I still think there is substantial upside possible from here, and we will explore that on the next slide. These projections are very aggressive and are very dependent on where we are in the S-curve of adoption. If we are earlier in the S-curve, then these projections aren't too far off, but if we are in the middle or the tail end, then these will land pretty far from reality. They have the growth rate at 90% next year and very slowly declining from there. The resulting revenue would be $57.8 billion in 2031, and with a PS ratio of 2.5, which is still solidly low for a fast-growing category killer like these projections imply, the projected value would be $144.5 billion in 2031. If a higher than average profit margin of 13% is applied, Lemonade would generate $7.5 billion in profit. If a fair PE of 50 for a category killer is applied here, it would imply a $375 billion company in 2031. If these projections are anywhere near right, this would obviously be a very successful investment, even after the recent huge run-up in valuation. These projections might seem crazy, but in the next 2 slides, I'll show you why they might not be too far off. off. Shown here is a summary of the 3 previous slides, and then at the bottom is the implied value increase if each case plays out. Of course, these are all just food for thought and not a detailed analysis, so you can see the required growth to make this a viable investment at these valuations. Finally, I have assigned percentages to how likely I think each outcome is in the top right corner, and this has yielded an expected value of $64.5 billion, which is what I am considering as my expected value for my investment. Now let's look at another way to value the company, by total market share and market size. The US market size is huge, with $1.32 trillion in premiums written in 2019. Also keep in mind that this is just looking at the US market, and Lemonade has already shown that they can expand into Europe and possibly other markets as well. If we look at just the property and casualty insurance market, with a market size of $637.7 billion in 2019, and have it grow at a 3% rate, it would be a $909 billion market in 2031. If Lemonade captures 5% market share, which is similar to that of Allstate or Liberty Mutual today, it will be generating $45.45 billion in premiums in 2031. Moving on to life insurance, which was a $204.1 billion market in 2019. If this market grows at 2% each year, in 2031, the result will be a $258.8 billion market. If Lemonade captures just 3% of this, then they would be generating $7.76 billion in revenue in 2031 from their life insurance segment. Finally, the pet insurance market size was $6.05 billion in 2018. If it grows at a 7% rate, the resulting market would be $14.58 billion in premiums in 2031. If Lemonade captures 8% of this market in 2031, this would result in IFP of $1.17 billion in 2031 for Lemonade. I added all of this up in the top right corner, and these assumptions would imply $54.38 billion in revenue in 2031. If we flip back to the previous slide, you can see that this is closest to the optimistic case for revenue growth and implies some huge gains in future profits and valuations. So with Lemonade, all it comes down to is this: what do you think the growth prospects are for Lemonade? If you think they will be a multinational insurance giant, then at this valuation it's dirt cheap. If not, then you best stay far away from this stock. Quick note on what I'm doing. I do own Lemonade, and it is about 10% of my portfolio. I have a cost basis of around $54, and I plan to add more anywhere below that. And besides that, I will hold for the long term. So what do you think of Lemonade? Category killer or bubble? Revolutionary or just putting a nice wrapping around an old product? What do you think of my projections? Let me know in the comments below. Thank you for watching, and leave a like if you enjoyed, and have a great rest of your day.